What's up YouTube, it's Matthew here, and in today's video I'm going to explain the process of hard money lending with my flip project. So I'm going through a full renovation flip, starting that in about a few weeks here soon, or maybe a few days. It depends on when my contractor can start getting in there and doing demo and other things of that nature. Hard money lending is how I finance this deal, and I did make a video about hard money lending, and if you want to see that video, you can check through my channel. But I just wanted to make an updated version and just make a video specifically for my deal, like the numbers that I'm going to pay essentially for this property and how hard money works. And so if you're ever interested, or if you ever wondered, okay, what do points mean? Because I was confused with points for the longest time. And so I recently just learned a bunch about hard money lending and how it works and just the requirements. And so I'm just going to share my screen with you all and share with you all the different numbers behind hard money lending. Hard money lending is essentially a short-term loan that lenders give investors. They can last anywhere from 3 to 18 months, 24 months. And they usually have higher interest rates because it is a risky loan, because you're lending out to people who are dealing with real estate that can go up and down at any time. The market can crash, and it's super short term and they need to make money off of the loan. So of course the interest rate is going to be higher. These loans are pretty easy to get. It's not 100% beginner friendly because most hard money lenders require some sort of a down payment. Now you could do private money. Private money is like going to your uncle or your parents or a friend who has money and say, hey, I'm going to flip this property. Can you give me some money? Hey, I know you, I trust you. You don't need to put no money down. I know you don't have all the money in the world right now, but I want to support you. Here you go. And they give you the money. That's pretty nice. And so I'm working my way up to that point, and I talked to some people and they just wanted to see more flip deals under my belt. I did talk about my wholesale experience and things of that nature, but they just wanted to see more of the other things. But let me share my screen with you all and just get right to the point. All right, so right here, these are the rates that I'm dealing with right now. And I know in another video, I did share with you all how much I am spending on this property and things of that nature. Right here, I have all the numbers available. So my point is 2.5%. My interest rate is 12.5%. The points is something that you pay upfront, and it doesn't go towards anything essentially. That's just how much you have to pay them. That's just like their fee. And how you get this amount, it's going to be their purchase price minus your down payment plus your rehab. In this example, which I'm using, you're going to add your 10% down payment, but your 10% down payment is based off of this 60,000 plus this 66,000. So your down payment is really like 12,000 and some change, right? So that's your down payment. And then that's going to be subtracted from your purchase price, right? Let's just do this equals the sum of these two, and then we're going to multiply that by 0.1%. So that's my down payment. Now this point is actually based off of this rehab plus the purchase price minus my down payment. So I'm paying 2.5% based off of, let's just do 60,000 equals this minus this. And so my points that I'm paying, I'm going to add this 47,000 plus 66,000. And so this is going to equal 0.025 times this right here. And that's how much points I'm paying up front. Now interest payments, the way this operates is that this is how much I'm paying off of this right now. Until I draw from this rehab budget, that's how much I'm paying. So for example, my first month's interest rate, if I don't tap the rehab budget, is going to equal this 12.5% times this. I mean, obviously it's going to be divided by 12 because that's the annual rate. Let's do this divided by 12. All right, so we're going to take this times that. So that will be my first monthly interest payment. And that doesn't go towards the principal of the loan. Let me just clarify that 100% again. Points is going to be your purchase less your down payment plus your rehab. So mine is at 2.5% times that, so times 113,000. That's how much I'm paying at closing. Now my monthly payment, the way it works is that whenever I tap into the rehab budget, that's added to the principal amount. So right now, if I don't use anything in the first month, then I'm taking this and I multiply it by this, but this is the annual rate. So I divided it by 12. And so I can change that into a percentage to make that a little bit better. So it's times 1.04%. Now, let's say I do tap into the budget the second month. Let's say out of the 66,000, I put 20,000 into it. So what I'm going to do, and I'm going to take this, my purchase, and then I'm going to add $20,000, right? And then what I'm going to do this times this percentage. And so my second month is going to be $702. And so that's essentially how hard money works. And most hard money requires a 10% down payment, especially if you're a beginner. If you are more seasoned, then they may require less. And some hard money lenders require a bigger down payment. It just depends. Another thing that hard money lenders do, they loan to value. So they may loan up to 75% based off of the ARV, and then you still have to put your down payment. So for example, with this example, my loan to value, let's say my ARV is $210,000. My loan to value is $157,500. And so what they're going to look at my purchase and my rehab, and to see if it's under that $75,000. I mean, that 75% loan to value, that 157, which is it is. So they're only going to require a 10% down payment. But let's say it goes over this 157. Let's say it goes to, my rehab is a super large and I'm going to need 170,000. Then they can still lend me the money, but they're just going to require me to make that difference and require a larger down payment, if that makes sense. That does make sense for you all. All right, and then another thing that they requires, most hard money lenders are reserved. So with my hard money lender, they required me to, of course, have my down payment. And then they wanted me to have 25% of the total rehab and purchase amount. If I needed a loan for 120,000, they needed 25% of that. That's 24,000 plus my down payment of 12,000. So 25,000 plus 12,000, that's 37,000. So they want to see in cash, in different bank accounts, that you have like $37,000. And fortunately I did, by doing YouTube, by doing wholesale deals, by working part-time, by doing real estate, I'm fortunate to have that. And so the reason why they want reserves is that this rehab budget, they're not giving you this money up front. You have to tap in from your own money. And once the work is completed, then they'll reimburse you for the rehab that you paid. And so I didn't know that at first. I thought they kind of just, hey, I'm about to do the flooring. I need this amount of money. Can I have it? Okay, here's the invoice. No, they're like, you need to pay for it. They need a receipt. They need photos, and they need videos of the proof that the work has been done. So those are some of the aspects of hard money lending, and just how points are involved, how interest rates are involved, and things of that nature. All right, you all, hope you all enjoyed this video on hard money lending for specifically my flipping real estate, my flip project that I'm working on. I hope you all enjoyed this video. Be sure to like, subscribe, comment down below, and I'll talk to you all later.